All right, welcome everyone. Um, Jordan Pence here with Advisors Resource Company. Um, it's 3:30 Central, and I'm going to let everybody join in. But today, I've got an exciting topic. We're going to talk about top 10 IULs, our take on them, what we think about them, and what we found. So before I get started, I'll let everybody join in. I'm gonna get back to the right screen. Hopefully everybody can see my screen, and we will get going. Again, my name's Jordan Pence. My company is Advisors Resource Company. I've got Chris Workman on here. Well, Brendan Healy, Daniel is also on here. But anyways, we're going to talk about the top 10 IULs that we think on the market. What we're going to do is discuss the challenge with comparing illustrations, do a carrier analysis, talk about the true value of index universal life strategies and index and strategies for these types of products. So I promise these things to be about 15 minutes long. So let's get right into it. First off, the top 10 IULs on the market. There's a lot of noise out there of who's got the best products, so forth, and everybody's got their own opinion. I mean, you talk to 10 different agents, 10 different advisors out there. They say X is my favorite because it has the most income, or Y is my favorite because they have XYZ index. So, Chris, why don't you let us know before I go into these how these were run, what were the parameters, and the rate class, that sort of thing.
Yeah, so each one of these were based off a 45-year-old male using a rate class of preferred.
Okay.
They're putting in 25,000 for 20 years, and the face amount on each one of these was just the minimum face amount.
Okay.
As far as the death benefit, it is increasing for the 20 years you're paying in premiums. And then the following year will start income and also have a face value reduction. So income's being shown from 66 to 100.
Fantastic. Thanks, Chris. And these were all utilizing the spread loans or the variable loans, right?
Correct. These were all variable loans, and these were all run with the S&P 500.
We utilize the S&P 500. So it's the base indexes as they call it now. And some of these companies do have various bonuses built into them, but usually in the S&P, in my experience, they're generally lower than like some of the non-volatility indexes that have, ridiculously high bonuses I've seen. So, anyways, without further ado, let's get right into it. So, number one of the highly rated companies that we ran was Corebridge Financial. They have a product called the Max Accumulator Plus 3, and the income on that was 82,100. And what I'm going to point out here is just the top three and take a look at their cash values, which I think is very interesting. Um, you look at Corebridge's cash value run at 7%. Well, that's basically the same as American National's run at 6.3. Now, American National does have a 0.25 bonus or additional credit, but Corebridge also has a 0.1% bonus. And then down here with quite a bit lower in cash value is North American. And I think we'll get into that a little bit more here in a little bit. So those are the rates of return, the indexes that we chose. And what I want to highlight here now is this column. I'm going to use my laser pointer. This column right here, the expenses through the first 20 years. There's some dramatic differences there. And I'm going to just highlight these on these top ones. Corebridge, 90,000 total expenses through the first 20 years. American National, 65,000. North American, 134,000. So how do they have the highest charges, the lowest cash value, the lowest rate of return, but income that almost matches American National. To me, when I look at this, this doesn't make a lot of sense. You could argue the same thing with the Corebridge illustration. Why does Corebridge have 900,000 of cash value, but that's 10% more in income? Well, a little less than 10% more. So why is that? I'll go to my next slide here. There's the income again. So this really comes down to the underlying problem, the problem of comparing illustrations. You know, the insurance regulators have put in a lot of regulation over the years with regard to how insurance companies can run their illustrations. It started off with AG 49, then AG 49A, and then some people are calling it AG 49B, AG 49 2.0, whatever they call it. It's the newest regulation, which came about it was a little over a year ago. And this is the problem with comparing these illustrations. You have the bonuses, which AG 49 was supposed to, well, AG 49A and B were supposed to levelize the playing field on that. You have the regulations, which is limiting the loan spread to only 0.5%, and the fact that you can't totally illustrate what the actual loan rates are, even if they are variable, or even if they are much lower than 0.5 less than the gross rate of return. So, like, for example, on American National's illustration, current loan rate is 5.2. Well, that the loan rate has to be forced to 0.5 minus the gross rate of return of 6.3. So um, it ends up being 5.8 over that time period. So it's kind of one of those weird things that the insurance regulators have made it actually more difficult to compare these products by seemingly try to level the playing field. So you really have to dig into it. So even though there's this regulation and all that, why does Corebridge have so much more income? Why does North American have so much more income given their cash value is $100,000 less? Okay, so this is one reason why. And I don't necessarily think this is a bad thing that Corebridge is doing with their illustration. I mean, I like the Corebridge product. It has a high cap. There's a lot of interesting features with it, but you've got to really pay attention to what these companies do. And I'm going to highlight something here. The participating loan that was used in the illustration that we just looked at receives an additional 1% account value enhancement on any indexed interest rate account beginning in policy year number 6. So what exactly does that mean? It took me a little while to figure this out, and this is actually North Americans actually doing a similar thing, and they have similar language. I think their bonus is actually bigger than the 1%. North American slash Midland is the same product, but what they're doing on the loan balance, they're giving an additional 1% account value enhancement on the loaned out portion. So, like, for example, if you have $100,000 loaned out, they're doing an additional $1,000 interest credit on that account balance. So what does this do? This gets the loan spread up to 1% plus the AG 49B regulated 0.5%. So their illustration has a 1.5% loan spread as compared to American National's 0.5 spread. And you can see how that would make a big difference. I mean, when you're talking about index loans where you have, you know, hundreds of thousands of dollars loaned out, changing that spread from 0.5 to 1.5, that makes a massive difference on the amount of distributions you can have. Now, after year 6, I mean, that's not that far in the future, but after year 6, what happens to the policy? What happens to the loan rate? Are they going to make some changes to the policy to make up for the 1% account value enhancement? Maybe that's where interest rates are going to be in the future anyways, and they don't drop their interest rate as fast as others may. Maybe they do, maybe they don't. I mean, I don't know what's going to happen, but that's certainly something to consider. And it's just another lever that the insurance company can pull. And in my opinion, the only reason to do this is you're making your illustrations just look better. I mean, a 1.5% spread versus a 0.5 spread is huge. It's absolutely massive. So I got a question. What are they doing given a 1% bonus? How can they illustrate that when you say the rules, they can only illustrate 0.5%? It's interpretation of the rules, I guess. North American's doing the same thing. There's other companies that are doing the same thing. So Corebridge isn't the only one that's doing that. But the benefit you can see is, well, starting in year 6, the actual loan rate should be 4.21. Is it going to be that? I don't know, but it's a good question. I don't know how they're getting away with it. It's just like the multipliers, right? When AG49, the original came out, they limited the loan spread to 1%. Well, insurance companies just implemented bonuses that got that spread up even higher. So, I mean, maybe they'll crack down on this at some point. I don't know, but yeah, it's just one of those things. I don't know. I don't know how they can get away with it. So, well, I'm gonna go back one more thing. So I'm just gonna go back to this slide again. So, I mean, you've got to really be careful when you're comparing illustrations. That's the bottom line. I mean, Corebridge has very high expenses. North American has very high expenses. Maybe that's how they're paying for this extra bonus, but you really can't just compare these numbers. You can't compare what's the highest income. You can't compare how much loans you can bring out, because some companies are doing this additional loan bonus spread. Another one that does it that I didn't even put on this list is F&G. I know for a fact that's how they're getting to such high income levels. So anyways, what do we like about IULs? Reason we do a lot of IULs is number 1, accumulation, number 2, the tax treatment, and number 3, the indexing. Now, one strategy that we happen to do a lot of, and I'm going to share with you just briefly our presentation that we use, is life insurance retirement plan, LIRP. I don't know what other, there's a bazillion other names that people come up with for this, but it's life insurance retirement plan. And we've got a special presentation that compares the life insurance to other ways that you can save. So you can see right here, this is just a snippet from our presentation, but it's got income of 82,000 on the life insurance, 48,000 on a taxable investment. So if you put the same 25,000 into the taxable investment and then took income starting at age 66 to 100, that's how much you could draw out versus an annuity and a qualified plan. So this is just one of the presentations that we put together, and we just brand it to the advisor in their firm. So pretty slick presentation and pretty good use of the Index Universal Life product. So I'm going to stop here for a second. Let me know if there's any questions. Feel free to add it to the chat. I've included my contact information as well as Brendan Healy's information. Chris Workman, thanks for joining us today. Chris, I didn't do a proper introduction of Chris, but Chris is our case design specialist. So that's why I asked him about how these were run, because he did them. And he's a great resource for us and the people who we're working with. And we'll probably be following up with everybody as soon as we can that was in this webinar. And if you have any questions, feel free to reach out directly to either myself or Brendan Healy. And got a question. How do we find the illustrations? If you reach out, you can, Chris can send you any illustration. So feel free to reach out to Chris. Great. Well, thanks everybody for joining. Hope you found this session interesting, and feel free to just reach out if you have any additional questions. Thanks.